and my name is Ryan Watts, and I'm the Executive Director of the Kentucky Oil and Gas Association. And this is our 6th webinar summer series installment. And today we'll be hearing from Sean Rainford, Manager of Refined Products Supply for CountryMark, who will discuss the market drivers for the U.S. oil industry. His full bio can be seen on the chat feature listed in this webinar. We want to thank our sponsors here today, especially CountryMark and Ergon, who are presenting sponsors for this whole webinar series. In addition to that, we'd like to thank the other ones who have made this series possible, which include AquaClear, Bingham, Greenbaum and Dahl, Bitco, Black Ridge Resource Partners, Britannia, CountryMark, Diversified Gas and Oil, EnLink Midstream, Ergon, Hughes Land, Phil Brown Insurance, Reliance Well Service, Steptoe and Johnson, Wyatt Terrett Combs, and then Cumberland Valley Resources. So thank you for your continued support. A couple of housekeeping items. One, during this presentation, you'll be able to ask questions of our presenter today, Sean. You can do that at any time through the question and answer feature on the webinar. So be sure to send your questions early so we make sure that they get asked in the appropriate time. Past episodes of our webinar series can be seen on our website at kyoilgas.org/summer series. We'll be taking a break next week. I think we'll give just everybody a little break here, and then we will resume on July 28th. And we will hear from Doug Curl, the Kentucky Geological Survey, who will talk about the new features in the KGS oil and gas database, their search functions, online geological map service, and so much more. And then, Sean, we thank you for presenting today. And if there aren't any other questions, I will turn it over to you.
Today, very much appreciated. So today's presentation will be focused on market drivers for the U.S. oil industry. It's been a very interesting year, to say the least. With COVID pretty much wreaking havoc worldwide. So this presentation, the crux of it is to go over a lot of the fundamental stuff, then go into the drivers for crude oil as well as refined products, as well as look at some, outlook for the near term as well as further out. So with that, I'll just move to just a brief overview of what we'll cover today from the synopsis. All right. So on this slide, we're going to start with crude oil. Now, for the uninitiated, crude oil is a liquid fuel source that is located underground, formed over hundreds of millions of years ago. It is extracted through drilling. The oil is refined and is used for transportation, various petroleum products, as well as the feedstock for plastic. Between 50% to 97% of the oil is hydrocarbons. Crude oil is the base for a lot of products. These include transportation fuels, such as gasoline, diesel, and jet. It's also included fuel oils used for heating and power generation. In 2019, the United States consumed 7.5 billion barrels of crude oil. Of that, 3.4 billion barrels was used to make motor gasoline. Another 1.5 billion was used for heating oil and diesel fuel. More than 600 million barrels was used for jet. When the hydrocarbons burn, they release the heat that formed them. They also, as a byproduct, release carbon dioxide. Crude oil also creates petroleum products, byproducts such as tar, asphalt, paraffin wax, as well as oils. It's used in chemicals such as fertilizer, perfume, insecticide, soap. even vitamin capsules. Higher oil prices increases the prices of other fuels. This is just a relationship, very closely correlated. It is responsible for 54% of the price of gasoline. Distribution costs make up around 15% of the price of gas, and the taxes add, depending on where you are located, upwards of 20%. The remaining 13% is predominantly related to refining costs and profit. Crude oil prices affect 95% of transportation. That creates higher food prices. It also impacts 45% of industrial products and around 20% of residential use. As a result, higher oil prices increase the cost of pretty much everything you buy, thereby leading to inflation. You'll see on the lower left-hand corner, there is an icon for OPEC. OPEC is the Organization of Petroleum Exporting Countries, basically a loose, effectively a group of 15 oil producing countries throughout Middle East, Africa, and South America that is responsible for a lot of the crude oil that is flowing throughout the world. In the year 2018, OPEC exported 25 million barrels of crude oil per day, which is 54% of the world's total exports of 46 million barrels per day. Between the 15 member nations of OPEC, they hold 82% of the world's proven oil reserves. So to say the least, OPEC's decisions have a significant impact on current and future oil prices. The oil and energy ministers from the OPEC member nations meet at least twice a year. However, when there are certain events, can meet much more frequently than that. Each member country in the group abides by an honor system in which everyone agrees to produce a certain amount. If any of those member nations wind up producing more, however, there is no sanction or penalty. Each country is responsible for reporting its own production. As such, there is cheating, and there has been a history of cheating going back to the early days of the cartel's origination. However, a way to balance and check production quotas is that a member nation will not go too far over its expected quota unless it runs the risk of upsetting the other members of OPEC and potentially getting kicked out. Despite its power and influence, OPEC cannot completely control the price of oil. However, in some countries, additional taxes are imposed on the refined products to promote, conservation and self-sufficiency. A lot of times, oil prices are set by the oil futures market, which we'll get into later. And in those futures markets, that price is determined more or less by the traders. Moving to slide 4, we'll just briefly go over refineries. So crude oil in and of itself is not valuable. Can't really do too much with it in its natural state. The value from crude oil is derived from the products that it can be created from it through refining. Therefore, oil refineries serve an important role in the production of transportation as well as other fuels. The crude oil components through refining, once separated, can be sold to different industries for a broad range of purposes. As you see on this slide, refineries monetize crude oil by transforming it into finished products. So crude oil goes through various distillation processes, treating processes to make finished products. And it's hoped that the value of the finished products exceeds the cost of crude oil that is used to supply it. So the United States oil refining industry is pretty expansive. As of 2019, there are 135 refineries in the country across 30 states. Currently, we have just under 19 million barrels per day of operable crude distillation capacity. Of that, almost 19 million barrels per day, almost 10 of it is purely gasoline production. 4.7 million of it is 15 parts per million, also known as number 2 diesel production, and just under 2 million is of jet fuel kerosene production. If you were to add up the daily production of gasoline, diesel, and jet, it would equal roughly 680 million gallons, or a little over 75,000 trucks per day of product. So quite a bit. And as you can see, the logos, these are some of the larger refiners in the country. So now we'll move into the crude oil market. And in particular, when we're talking crude oil market in the United States, you're talking about Cushing, Oklahoma. Cushing is a small town in Oklahoma, about 8,000 people, not a whole lot to see. However, it is literally the epicenter of crude oil market, definitely in the United States, probably the world. But why is that? Well, first is the infrastructure. So Cushing, Oklahoma is the physical delivery spot for all crude oil bought and sold in the NYMEX West Texas Intermediate Futures contract. So when we look at the futures contract for crude oil, that is actually a physical product that can be delivered, and the delivery location is Cushing, Oklahoma. Cushing, Oklahoma has a capacity of roughly 90 million barrels of storage across 15 terminals, which is just a little over a tenth of the total U.S. storage. It is the hub for roughly 24 pipelines. So it is literally the heart of crude oil pipeline infrastructure in the United States. It has a combined outflow and inbound and outbound flow capacity of 6.5 million barrels per day. Point 2, as a benchmark for pricing, much of the world's physical and financial oil and refined products transactions are linked to WTI, which means it's linked to Cushing, Oklahoma. Whenever we transact to buy oil for our refinery at Mount Vernon, Indiana, the value of the barrels that we purchase are linked to WTI, either as a premium to WTI or as a discount to WTI. So it's used for pricing, but also used as a comparative tool to determine the value of products, be it crude, be it gasoline, be it diesel or jet, on a percentage basis of the barrel. The third point, market demand indicator. The storage levels at Cushing are reported every week by the Department of Energy inventory report. It comes out every Wednesday, 10:30 Eastern Time. And what that report represents is the indication of crude demand in the U.S. and worldwide. Worldwide because Cushing, though it is landlocked, can be piped to export markets in the Gulf to ship worldwide. So depending on the storage levels that's being reported, the market will then react, and oil prices can be impacted substantially. Here is a map of the very complex North American crude pipeline system. So as you can see in the center where that yellow star is, that is where Cushing, Oklahoma is located. And Tritiform is in the center of everything. It is a major hub for pretty much all flows, either inbound from Canada or from other areas of the United States, West Texas, also point to export into other locations in the upper Mid-Con or in the Gulf Coast, or even as far as the Rockies. So suffice to say, Cushing is quite literally the heart of the North American crude pipeline system. So what are the things that, or factors that affect the crude price? So on the supply side, OPEC policy. Because of their vast amount of production capability and reserves, OPEC can quite literally make determinations simply by taking on production or cutting production. And we're seeing that currently in the market where crude is trading around 40-ish on a WTI basis. Other grades are trading a little bit higher, mainly because OPEC has curtailed production for most of the summer in response to the lower demand stemming from the COVID pandemic. Shale growth, domestic shale growth here in the U.S. So the U.S. has the capability of producing upwards of 13 million barrels per day of crude oil that they can bring to the market. So this is very different from years past where the United States would have no or very little price influence to now the United States, through its own ability to produce substantial amounts of crude oil, can influence global oil pricing. Future available supply and reserves, as touched on, OPEC member nations have about 80% of the world's proven crude oil reserves, and crude oil is a non-renewable resource, meaning when it's done, it's done. So if the view of the market is, we're running out of crude to potentially discover and produce, then that can inflate oil prices. Conversely, if we feel that if the market feels there's too much crude oil in the market, that will also depress prices. Political events and crises, so, typically, war or some type of conflict, tariffs, trade wars, you name it, all can influence, the market's view in terms of the value of crude price. Weather goes without saying, hurricanes, tornadoes, earthquakes, especially in production areas, can lead to major supply disruptions, which can substantially impact the price of crude and refined products. Takeaway options, as we'll discuss later, crude needs to be in a market where it can be, taken to be bought and refined. If your crude is in an area, in a region where it can't, where there isn't sufficient takeaway, then that can depress the price because it's effectively, unable to be processed or taken to a market area to receive greater value. And investment in oil production areas, basically, as we're seeing it in this current environment, a lot of producers in the oil and gas space are reducing CapEx and also stripping CapEx altogether due to the lack of demand in the area, and in addition to the lack of investment from banks, private equity, other financial firms are less incentivized to take the risk to invest in the oil and gas sector due to the current events surrounding the coronavirus. On the demand side, GDP, gross domestic product, is a huge driver of energy consumption. So as economies continue to grow and mature worldwide, and people move up their living status, typically, they'll acquire greater amounts of energy. Gasoline, diesel, jet demand, typically, in the summer, you have strong gasoline and jet demand as people are more inclined to travel. That has not been the case this year due to the coronavirus. Diesel demand typically strong in the winter as people look to heat their homes, but also in the spring and fall for agricultural purposes. Refinery utilization, quite frankly, the biggest buyer of crude are the refineries. So low refinery utilization rates imply that, crude demand is low because the refinery is unable to make substantial profit running the crude. So higher refinery utilization rates are typically more desirable because that means the refinery is making margin, which means they'll have appetite to run more crude. Interest rates. So this is an interesting school of thought. So the reality is that oil prices and interest rates do have a correlation, but they're not exclusively correlated. To be perfectly blunt, many factors affect the direction of both interest rates and oil prices. Sometimes those factors are related, sometimes they affect each other, sometimes, there's no rhyme or reason. The theory is that increasing interest rates raises consumer and manufacturing costs, which reduces the amount of time and money that people will spend driving or consuming energy products. Fewer people driving on the road or traveling will translate into less demand for oil, which can cause oil prices to drop. So in this example, it's kind of an inverse correlation. By the same token, when interest rates are lower, consumers and companies are able to borrow and spend more freely, which means they have more disposable income to travel, which means they'll use more gasoline and jet fuel and sometimes diesel fuel, which will drive up demand for oil. Currency values, simply put, the currency you use to purchase any commodity, not just crude, has a substantial impact on your purchasing power. So WTI is always priced in the dollar, and we'll see later on that there is a relationship between the relative strength of the dollar versus crude oil and how that impacts crude oil prices. Demand, weather seasonality. So when it is cold in your home, you're looking to utilize your home heating options, which means it'll typically drive up demand for diesel fuel. Conversely, when you're in the spring, summer, and you're looking to travel, that will typically be a boost for gasoline and jet demand. And the last part of the demand equation is traders. As mentioned, financial traders in the market can speculate on crude price, thereby driving up the value based on their belief as to whether crude price will rise or fall based on available fundamentals and market view. So in this chart, this slide, we'll discuss oil price volatility. So oil was first discovered in Pennsylvania in the mid-1800s. And for most of its history, over 100 years, the price of oil was relatively stable. As you can see, rarely going above, 30 to 40, $40 to $50 a barrel. In 1974, there was an OPEC oil embargo, which increased the price of crude to around $55. In 1980, you had the Iranian Revolution, which spiked crude oil to over 100, which was the first time it's seen those levels since the 1860s. And then in 1981, the New York Mercantile Exchange selected West Texas Intermediate as the benchmark U.S. crude oil contract for futures trading. And since that time, oil has been very volatile, due in no small part due to the introduction of traders, speculators who take positions and try to profit off of the various fluctuations in crude oil price. Moving on to current events. So this is an example of the EIA report that comes out every Wednesday morning. This is from Wells Fargo. And as you can see, crude oil inventories on Exhibit 6 nationwide are very, very high, which is somewhat reflected in the price of around $40 for WTI. We're well above the 10-year average, as well as where we were for 2019. So this is a very bearish indicator in terms of crude oil pricing, because it says there's a substantial amount of inventory overhang that needs to be worked off, and that there's just a lack of overall demand for the product from refiners. But moving to Exhibit 7, we look at the Cushing inventories, which, as you can see by that yellow star, we're approaching tank tops in late April. So for many of you, the big story in the news on April 20th was WTI crude oil price went negative for the first time in recorded history, trading at minus $37 or so. And there are a myriad of reasons as to why that happened, but it goes back to the point that I made earlier on the earlier slide, is that Cushing is a actual location, and the contracts, the NYMEX contract that you trade, are linked to a physical barrel. And you need to have storage if you have intention of taking delivery of that physical barrel. If you do not have storage, you need to find storage. And if you're unable to find storage, then you get caught long, and then now you have to find someone to take this off your hands. So that's, in a nutshell, what happened. A lot of people had length on the May futures contract because, again, you always trade the next month out when you're trading futures, and by the time the deadline to settle up, your positions is typically around the 20th of the month preceding physical delivery. So a lot of people got caught long with barrels, and they didn't have any place to store it. So in order to incentivize those who did have storage, the price came down considerably. And a lot of people lost a lot of money. offloading their crude obligations to someone else. Next, we'll talk about the refined product market. So, what makes up a barrel of crude oil in terms of petroleum products? Well, as you can see, the lion's share of it is gasoline, around 19 gallons, followed by distillate, which is around 12, 13 gallons, followed by jet, which is about 4.5 gallons, and you have a mix of resid and hydrocarbon liquids, amongst other things that make up the balance. You'll notice that the math does not always add up to 42 gallons, which is the nominal measurement of crude oil barrel, and that's due to the processing gains due to refining. So as you refine crude oil, heat will break up hydrocarbons and expand, and therefore you will get more products from the yield. So the crack spread is pretty much the key determinant in refiner profitability. So in this example, we're looking at a 3-2-1 crack spread. So the 3 represents 3 barrels of crude, the 2 represents the barrels of gasoline, and the 1 represents distillate. So 3 barrels of crude, you should, on average, get about 2 barrels of gasoline and 1 barrel of distillate. And what you want is your refiner or your price of your 2 barrels of gasoline plus your barrel of distillate to exceed the price of your 3 barrels of crude. That is known as a positive crack spread margin. Conversely, if your barrels of gasoline and your barrel of distillate is lower than your price of your crude, you have a negative crack spread margin. So in the same vein that a baker would want their cake and cupcakes that they make to be worth more than the cost of their eggs and milk and flour used to create it, a refiner wants the price of its products that it makes and manufactures to be greater than the cost of its inputs. In this example, crude. There are a number of ways you can slice this. There's a 5-3-2, there's a 6-3-2-1. There are a varied amount of ways to measure manufacturing margin from a crack spread perspective. But for the purpose of this presentation, simple, cleanest, easiest way was to use a 3-2-1. So, what makes up the price at the pump when we buy gasoline? So, the largest components in these 2 examples, we look at the historical price going back 10 years and what the price was for 2019. And obviously, the price will probably be a lot lower for 2020. But for the purpose of this example, as you can see, the cost of crude oil is the largest factor in the retail price of gasoline. The cost of crude oil as a share of the retail gasoline price varies over time and across regions across the country. So, the relative cost of crude oil is different in Texas than it is in, say, Indiana, than it is in New York, than it is in California. Domestic crude oil prices are determined largely by fundamentals, including supply and demand, inventory, seasonality, and financial market considerations. Taxes make up the second largest component of your retail gasoline price. Federal excise tax for gasoline is about 18 cents, and there's another tax called the leaking underground storage fee that's about a penny a gallon. So between the excise tax and the leaking underground storage tax, you're at about 20 cents a gallon right there. State and local taxes, again, vary by region. but nationwide in 2019 averaged about 28 cents. Then you have sales tax, which is applied by local and municipal governments, which can also impact the price that you pay at the pump. Then you have refining costs and profits, which have largely stayed flat over the course of the last 10 years as refiners have become much more sophisticated in terms of manufacturing crude and doing so economically. However, the refining costs and profits do vary based on the season as well as the region, and partly because of the different gasoline formulations that are used to reduce air pollution in different parts of the country. The characteristics of the gasoline produced depend on the type of crude oil that is used and the type of processing technologies available at the refinery where it is produced. Gasoline prices are also affected by the cost of the ingredients that may be blended into gasoline, such as ethanol. Increased demand for gasoline in warmer climates, as well as the warmer part of the year, such as the summer, will generally result in higher gasoline prices. And the final component of price for retail gasoline is distribution and marketing and relative dealer costs. Most gasoline is shipped from refineries by pipelines to terminals near consumer areas where it may be blended with other products like ethanol to meet local government and market specifications. From those terminals, gasoline is delivered by tanker truck to individual retail stations. You'll see that some retail outlets are owned and operated by refiners, such as Marathon, Valero, CountryMark, while others are independent businesses that purchase gasoline from refiners and marketers for resale to the public. The price of the pump also reflects local market conditions and factors such as desirability of the location and the marketing strategy of the owner. Actually, I need to correct myself. CountryMark does not own and operate independent gasoline stations. Those are done by our members. So apologies for that. On this slide, this is 3 of the largest pipeline systems in the United States. Colonial Pipeline on the upper left is the largest refined products pipeline system in the United States. It connects from the refining hub of the Gulf Coast all the way up through the southeast United States, all the way up to basically New York Harbor. Colonial Pipeline transports a little over 3.5 million barrels of refined petroleum products per day on its system. Below that map is the Buckeye system, which originates in the East Chicago area refining hub and stretches throughout the Midwest and which also connects to other pipelines that can deliver into the East Coast. Buckeye does about a little over 1.5 million barrels per day. And then you have the Explorer pipeline system, which also originates out of the Gulf, as well as other parts of Texas, North Texas, and also through the group in Tulsa, Oklahoma, and that connects and runs all the way up into the upper Mid-Con to the St. Louis and Chicago markets. So all in, you're looking at just around 5.5, 6 million barrels per day of refined products transportation in the U.S. via pipeline, just on these 3 systems alone. So gasoline demand, with gasoline being the largest part of the barrel, obviously refiners are incentivized to maximize production of gasoline. And gasoline demand is a huge driver. And as you can see, over the last 10 plus years, dating by 2010, gasoline demand has largely been increasing from around 8 to 9.5 million barrels per day. However, due to COVID, at the peak of COVID, which is what this chart reflects, gasoline demand had cratered to levels not seen since 1994, which is right around 6.5 million barrels per day. Now, with summer demand and people traveling more due to relaxed restrictions, gasoline demand has improved to where it sits right around 8 million barrels per day, which is better than where it was 2 months ago, but is a far cry from where we were last year and in years past. More EIA charts. So here we see that due to, in no small part to COVID, we have a substantial inventory overhang nationwide. Gasoline, we're sitting at well above the 10-year range and 2019 levels at 260-ish million barrels of gasoline, as well as the diesel, same story, well above the 5-year range, sitting right around at 170-ish million barrels of diesel inventory nationwide. Anecdotally, this is the highest amount of distillate inventory since 1983. So here we will move on to basically what's going on in the market and what's impacting crude oil and the oil industry at large. Well, first and foremost is the coronavirus. As it stands, worldwide, we have about a little over 13 million cases of confirmed cases of COVID. Of that 13 million, just under 3.5 are in the United States, and just around 6 million or so is concentrated in Europe, Middle East, Africa, and Asia. So this is by far the biggest driver of what's going on in the world, to say the least. And until this is in control via vaccine or reduction in virus transmission rate, we're pretty much at the mercy of this virus, and the industry as a whole is at the mercy of this virus. So here, we're going to discuss pipelines and recent events surrounding infrastructure surrounding crude oil pipelines. So on June 25th, we had a Michigan County judge which temporarily shut down Enbridge's line firing system, which transports roughly 400,000 barrels per day of crude from Western Canada to refineries in the upper Mid-Con, such as in Ohio, Toledo, and Detroit, and Michigan, as well as in Ontario. That has since partially reopened. However, not to be outdone, just last week, we had 2 very major decisions on crude oil pipelines in the U.S. The first being the Supreme Court refusing to allow construction to start on Keystone XL, which is a planned almost 1,200-mile pipeline that runs from the oil sands of Alberta, Canada, down to Steel City, Nebraska, which then connects to existing pipeline infrastructure to deliver those barrels to the Gulf Coast and Midwest market. So that decision effectively impacts around 800,000 barrels of oil each day. And then we have District Court of Columbia, U.S. District Court of Columbia, ruling that the Kodak Access pipeline, a major takeaway option for Bakken producers, has to be shut down on August 5th, which effectively takes 500, almost 600,000 barrels per day of capacity from the Bakken, which is already an area with very limited export options and regional demand. Prior to DAPL, Bakken crude production surpassed regional pipeline capacity, meaning producers and operators had to ship volumes by rail at a discount because rail is not cheap. As a result, Bakken would trade at very deep discounts to other benchmarks, mainly due to the cost of the rail. Now, without DAPL, the existing pipeline infrastructure in the area is insufficient with the current production levels. And even with, the COVID pandemic shutting in 300,000 to 500,000 barrels per day of production, it still exceeds the available pipeline capacity without DAPL. So what we can look for is more rail shipments, which is dangerous because you have a higher risk of rail spillage, and the potential for producer shut-ins, because at crude at $40, and Bakken typically trades at a slight discount to WTI, and then you have to pay, to rail it out. Those economics would be $10 to $15 off of that price. So now your Bakken price of $37, $38 with rail is now in the low to mid 20s, which at those economics are just not conducive to continuing to produce crude in that area. So if this goes through, I feel very confident that there'll be quite a large number of production shut-ins. GDP. So this chart, this graph from the International Monetary Fund shows projections in terms of what 2020 will look like in terms of economic growth. And as you can see, pretty much across the board, it's all negative. From a global standpoint, GDP will probably contract around 3%. In advanced economies like the United States, Japan, and Europe, GDP will probably contract around 6%. And in emerging markets, India and Brazil, which have in recent years seen GDP of 3 to 6% on an annual basis, that will contract. However, all is not lost. In 2021, we are forecasted, assuming, again, that we have some sort of control over COVID-19, that GDP should rebound and we should get back to some semblance of normal economic growth and progress. Well, the wild card is obviously the coronavirus. This chart here from Google Mobility and Goldman Sachs just shows how people have changed their movement habits in reaction to shutdowns by local and national governments to help try to curb the spread of the coronavirus. So to the chart on your left, you see that retail and recreational activities like just going to shopping to the mall or going to the park, going to the beach, have rebounded quite a bit from the lows of early April. You know, still not all the way there to pre-pandemic levels, but you see in the various reopening phases, the criteria that, you know, there is improvement in people movement, which is a good sign for obviously oil and refined product demand. However, to your right, you see the change in human mobility was starting, as it relates to return to work, was starting to pick up, but has since leveled off in June, mainly because employers are equipped or don't want to run the risk of virus transmission spreading throughout their workforce, which is why so many people are continuing to work from home. This is a headwind because the more people stay home to work, that's less people doing the morning commute, doing the rush hour commute, which means their cars aren't driving, which means there's less demand for fuels, which invariably means there's less demand from refiners for crude oil. So as touched on a few minutes ago, the relative strength of a currency has a relationship to the price of crude oil. And as you see, your gold line, which represents crude oil, and your black line, which represents the dollar index, there's sort of an inverse relationship here, going back for this chart, the last 5 years. Whereas when the price of crude is relatively low, the dollar typically is pretty high, and vice versa. And you can even see now between those red lines for 2020 that the relative weakness of dollar, which is trading right around 96, 97 cents, is somewhat of a bullish indicator for crude. Now, obviously, there are much more macro factors at play that we touched on that determine the price of crude. However, a very strong dollar does not incentivize people to buy U.S. commodities that are typically priced in the dollar. That's just how it is. Right? No one wants to pay more for a product than they need to, and they'll look at other markets where their purchasing power is stronger. Now, when you have the dollar that is relatively weak, you now incentivize people to want to buy your goods and services, and this is the story for WTI. So this chart from Energy Aspects, which is a research and consultancy firm for the oil and gas industry, shows that, in response to the pandemic, refiners worldwide basically reduced runs or performed maintenance, either planned or unplanned, while hopefully waiting out the worst of the pandemic, which drove down commodity prices substantially. While that was smart and prescient for the short term, at some point the refineries have to run, and this is what this chart reflects. So over the course of this summer and going into the fall and winter, there'll be less and less refinery turnaround, refinery options, refinery maintenance, which means effectively refineries are going to run, which could theoretically lead to more product oversupply in the market, which would be very bearish for oil and refined products. But all is not lost. This chart from Platts, as you can see to your left, demand dropped off considerably during the worst of the pandemic in Q2 of this year. But the majority of it, again, depending on what happens with COVID and the progress we can make there, should return by Q2, Q3 of next year. Here, this is obviously a pre-COVID chart, but as you can see, the United States, with its crude capacity being able to stay above 85%, has offset a lot of the declines in production from Latin American countries who have for years suffered from just infrastructure that has decaying, and economics and government and economic policy decisions that make it very hard to run a profitable refining operation. So here you have the U.S. becoming a huge exporter to many countries, but most notably Latin America. And some final thoughts as we wrap this up. The pandemic, COVID, is what holds everything in terms of the direction of where this market goes. We find a vaccine or cure before the end of the year, or even into early 2021, the world will be a better place for the crude oil and refined products industry. Population growth, especially in emerging nations such as India, Brazil, China, Russia, will drive long-term energy demand. OPEC Plus, meaning the cartel, along with Russia, as well as the U.S., are firmly entrenched as the production drivers of the crude oil market. Point number 4 is that the world will still need oil, even as other energy resources are making their way into the market, such as electricity and renewables, because those still require infrastructure to support widespread use. And you're not going to take 300 plus million cars that run on gasoline and diesel fuel off the market in a relatively short amount of time. The refining industry will experience some generational changes. We're seeing that right now with BP announcing its goal to be carbon neutral by 2050. Same with Shell. There's no easy way around it. Refining is just not the attractive place to be right now. So anticipate a lot of refineries being up for sale. We're already seeing it in the last, I'd say, year or so. A number of refineries exploring their options. So anticipate a lot of consolidation, as well as a lot of refineries, quite a few refineries just going out of service and getting mothballed due to poor economics. Second to last point, economic data is concerning. Obviously, the higher unemployment rate, double-digit unemployment rate, is not ideal, but we seem to be improving per the latest jobs number. The equities market has shown to be very resilient. So we're thought that the worst is behind us in terms of the pandemic effects. However, we're far from out of the forest and definitely need more positive news in terms of virus control as a vaccine to continue to rebound. And finally, as touched on in my last slide, U.S. crude production and refinery efficiency will help offset a lot of the production problems in the world, most notably other areas of the world that struggle with producing refined products. The U.S. is more than willing, capable, and able to help meet those needs. With that, I'll leave the floor open for Q&A.
Thank you, Sean. And I think it's a time for, we're getting close to the hour here, but I think we have a couple questions here. Let's see here. What was the increased volumes of lighter oils produced from the shale plays? What has the increased volumes of lighter oils produced from shale plays done to the refiners?
Good question. So the lighter oil typically that runs a refinery means you have more light ends, which means you're going to have more gasoline. So right now in the market, we're seeing a lot of tightness for heavier crudes, mainly because for a refinery to run optimally, it can't run all light grades. It has to run a mix. So it has to have some lights, some mediums, and some heavies as well. And your heavier crudes are what makes your asphalt, your resids, your fuel oils. So that's why, with Bakken as well as the decision with Keystone is very important and influential, because a lot of these grades are heavier grades that refiners need to have optimal crude slates to run optimal production for their economics. So the shale oil is good in terms of the United States being able to produce and not have such a reliance on imported oil. However, for a refinery to run optimally, it needs to have a mix of grades to optimize all the units, and you can't just run purely on light sweet grades.
Okay, thank you for that. How much latitude does the typical refinery have to change its output to reflect changes in the markets? For example, can you get more gallons of diesel out of a barrel of crude if it makes sense economically?
Yeah, the refinery has configurations where it can, increase crude rate. I mean, it can increase their gasoline make as well as their diesel make. What we're seeing is this year with jet fuel, a lot of refiners are backing out jet fuel simply because due to the lack of demand, and effectively diverting it into the diesel pool. So when you have jet fuel, which comes off the third level down in terms of processing or atmospheric distillation, what refiners will do is that they will configure their units to reduce the amount of jet that is produced, and then immediately turn it around and whatever jet is produced, drop it into the diesel pool, because right now diesel is much more valuable than jet. So the refinery does have ways to configure by changing endpoints or other machinations to optimize the product yields that it makes.
Okay, and I think we got time for one more. Did the ability to export crude from the United States, which at least temporarily helped producers, have any impact on U.S. refiners?
So the ability to export crude, I would say, in my own personal opinion, because the United States have been exporting a lot of crude up until very recently, and refiners are still able to run, because once again, the type of crude that we were exporting, by and large, was a light grade from Permian and DJ and the different basins. So as such, by us exporting, it didn't leave the refiners net short in terms of the type of crude that it needed. And once again, in order for a refinery to run optimally, it has to have different slates of crudes. Like, you won't find one refinery worldwide that just runs, by and large, one type of crude all the time. You have to run different slates because they're trying to achieve optimal yields for your products that you want to manufacture and sell at very competitive market prices. So I don't think, relatively speaking, that with the U.S., with the American, I guess, renaissance in shale production, that exporting those volumes had a substantial negative impact on domestic refining.
Well, perfect, Sean. We really appreciate your presentation today and all that the information that you provided for our association. And this will be uploaded probably as soon as this evening or early tomorrow morning. So once again, thank you for your participation in this webinar today. And I also want to thank Stacy Dover and Michael Nelligan and Emily Childers, who have run the show behind the scenes each and every week. So I really want to appreciate or give my thanks to them as well. So if there's anything else, do you have any last parting words for us, Sean? Okay. Well, again, thank you, and we will see you on July 28th. Thank you very much.
All right, thanks, everyone. Have a great day.
All right, bye.